what we've seen is yields have started to pick back up again. And the reason for that, very likely, is that those recession concerns are maybe dwindling a bit. Good afternoon. So we have some big news on the tariff front and a lot of inflation data to cover here this week. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal here at Mainsail is to leave you feeling more empowered after every interaction. And hopefully today in our Thursday update is to weed out a bit of the noise with all the data and all the market trends that we are seeing. So this week we'll start a little bit on the tariff front, although that will also tie into the other big story around inflation, and then also tie into our question of the week, which is a great one, which is kind of like what the heck is happening with bond yields. So we'll also cover that as we wrap up. But before we jump into the other two items, probably the biggest thing on everyone's mind right now, or at least in the headlines anyways, is this big news on a temporary trade deal with China that was announced on Monday. And obviously, if you do follow the markets, you probably saw that the markets really liked the news. The general takeaway is that there will be a rollback in tariffs on both sides for an initial 90-day period. Both sides, US and China, lowered the tariffs by 115 percentage points. So what that means at the end of the day is US tariffs, on Chinese goods went from 145% down to 30%. And then Chinese tariffs on US goods went from 125% down to 10%. So keep in mind that these are still different than they were before all of the tariff talk began. So there's still some weighing to do on how this all may translate into what's to come from here. But nonetheless, definitely a significant decrease from a kind of laughable, right, 145 and 125%, but nonetheless significant difference from where we were just a couple of days back. And I think the markets like this primarily because they see it as a sign of maybe more to come and some optimism maybe on where things land. Now, that said, only time will tell. So obviously we will continue to keep you posted as more kind of carries out here on this whole trade discussion. Tying that into inflation, which is really, these two items are really going to come up when we talk about what's going on in the bond market and with yields. But this week we had consumer price index data, CPI data come out. So consumer price index came out on Tuesday, and CPI and core were both up 0.2%, which was above expectations. But I think it was interesting. I think the market really kind of liked this to some degree. Maybe because of thoughts around maybe a Fed cut sooner, although I'll talk a little bit more about that here in a minute too. Or maybe it was just kind of a leftovers, so to speak, from the tariff news on Monday. And then fast forward to today, we also had producer price index data come out, and PPI was up 0.5%, but core up 0.5%, and core was down 0.2%. So obviously pretty significant difference between the two numbers there, and pretty significantly off of expectations for both of them as well. Take one reading as always with a grain of salt, but nonetheless it was very kind of interesting read here this week. And then we also had retail sales come out today up 0.1%, right in line with expectations. So not a lot to write home about. Before we break for the question of the week, be sure to tune in next week. As far as data goes, we'll cover consumer sentiment and we'll cover housing data. But for our question of the week, before we kind of wrap things up here today, is a great one about what is going on with bond yields, because the reality is that they have been all over the place over the past 5 months and change. So what I want to do is zoom all the way back to late last year. So hopefully this will set the stage for kind of where we've gone. And what I want to highlight is keep in mind that bond yields, there's a number of things at work when we look at how yields are priced. But one thing I'll mention is that in general, the Fed rate cuts and path and where they set the short-term rates has an impact, but so does inflation. And the reason I highlight that is because if we go back to late last year, what we started to see was bond yields actually went up pretty significantly heading into year end. And the reason for that is because, again, when the market looks at where they may want to invest, think about it this way: if you're going to invest $1,000 and give it to the US government for 10 years, you obviously want not only a return for that, but you are hoping that that return would be higher than your inflation expectations, right? Otherwise, what's the point, right? So in general, what we see is we see yields are based off of the short-term rates that the Fed sets, as well as some factor, much more than this, but some factor as well around what we expect for inflation moving forward. And so what we saw late last year was inflation expectations were increasing due to the incoming administration. As a result, we saw the 10-year, at least is really what I'm referring to, pick up quite a bit. Now, as the year went on, we started to see it kind of pull back quite a bit. And a big part of that, I think, was due to potential concerns of economic slowdown. So as valuations started to kind of get thrown into the mix, as we had some cracks in economic data, and then, of course, the fuel in the fire with the tariff news, what we saw was the market started pricing in more of a possibility for a recession. And as a result, rates came down, likely in expectation that if that were to occur, the Fed might cut rates, right? Maybe some of this had to do with inflation as well, but I would say probably more so based on concerns of a potential recession. Now, fast forward to today, and really the last couple of weeks, let's call it, because that was really the trend up until the very end of April. But over the last couple of weeks, what we've seen is yields have started to pick back up again. And the reason for that, very likely, is that those recession concerns are maybe dwindling a bit. The Fed just came out the other day saying they don't plan to cut rates for a while. Now, there may be some people reading between the lines there or suggesting that maybe there's a rate, that would suggest that rates go higher as well. But in addition to that, we saw a lot of economists, again, when the tariffs were announced, kind of suggest that this could mean a higher chance of a recession. Now, I think we all kind of knew things would change between now and then. Obviously, they've changed a lot just this week. And as a result of that, we're seeing a lot of economists pull back that recession call and reduce pretty significantly the chances that they see of a recession moving forward. So the reason I share all that is not necessarily to talk about is a recession coming or not, although I think a lot remains to be seen there of where we fall with tariffs, but more so to talk about how that relates to the bond yields. And that's ultimately why I think we've seen a little bit of an increase again here over the last couple of weeks in yields. So hopefully that's helpful. I know we talk a lot about the stock market here in these updates, and I know the bond market might be a little more boring, but it is important to cover. A lot of our clients are close to or in retirement, and so bonds and looking for safety is obviously a big component in kind of how we help. And this definitely translates to, those looking for income as they move into retirement. So hopefully that's helpful. A lot to cover this week. Be sure to tune in next Thursday where we'll cover consumer sentiment and housing data, as well as likely any updates, if there are any, around the trade news as well. Have a great upcoming weekend, and we'll see you next Thursday at 3.